Kia ora, everyone. Welcome back to our next edition of Econ Talks. Gareth, we've had the latest quarterly survey of business opinion out from NZIER, not showing particularly good things. Domestic trading activity doesn't look flash at all. I think the lowest reading for actual activity that's happened the last 3 months since 2009, since the GFC, if you exclude some of that lockdown activity. Sort of gels, I guess, with what we're hearing out there from businesses. The last couple of months, they've definitely noticed a softening in the economic activity. They're not seeing those same levels of sales, the same level of activity. That seems to be filtering through increasingly into the labour market as well. If your business isn't going well, you really are questioning not only about your potential hiring, but more importantly, if you're even keeping the staff that you've currently got. I mean, what is the latest there? How dark a business is feeling, and what does that mean for people's jobs?
Yeah, so that domestic trading activity, a net 28% of businesses saying it's been worse over the last 3 months than it had been previously. As you say, worst since the GFC, although during the GFC we saw the result get down to about negative 45. So it's not GFC bad at this stage. However, that is a pretty good indicator generally of economic activity, that particular measure. And so that does not bode well in terms of sort of GDP results over the next couple of quarters, potentially, just what it means through there. And you're right that it's feeding through into indicators around the labour market in particular. One of the numbers that we look at there is just around what has happened to employment over the last 3 months, and that matches up quite nicely with employment from the Household Labour Force survey over time. If that figure is correct, where that was down again quite substantially in the latest quarter, it suggests that employment in a couple of quarters' time could actually be down by 1 to 1.5% on a year ago. So that's quite a different narrative to what we've previously been talking about with the labour market, where we said, yes, the unemployment rate is going to rise, and we've seen some of that already. But the bulk of that increase, we thought, would just be people not being able to get jobs. There would still be job growth coming through, but not as fast as that labour force had been increasing, given, of course, the very strong net migration that we've seen. So there are risks, I think, that labour market deterioration that we have seen to date could well get a bit worse from here, particularly if it flows through into more job losses. And remember, of course, this is a private sector survey, so we're not really thinking about the public sector and the well-publicised job losses there. This is an indication of how businesses are feeling and their intentions around employment as well.
Totally. And I mean, it's interesting as well, looking through all of the various sets of numbers that we're getting through, all of them sort of pointing down, but some sort of pointing down far harder than others, the likes of the QSBO, certainly showing that actual employment data, filled jobs from tax figures at the moment, though, they're softening, but they're sort of a bit more stagnant on a year ago, and then don't necessarily look like they're falling all that much right here, right now. So, like I say, also might be one of those things where you're getting that signal now from businesses that'll flow through into the official numbers in the next couple of quarters. The other piece, of course, that the QSBO gives us an interesting read on, it's certainly been reacted to quite violently, almost in a sense this time round, was that pricing expectation of where inflation is going to go into the future. In fact, we saw some forecasters come out and say, look, inflation is beaten. The survey shows it. It's done. Why aren't we cutting now? We've seen at least one bank bring their interest rate pick forward for the first cut to now begin in November rather than February. I think you've got two of the forecasters now in November, the balance and the majority coming through in February. But everyone is sort of trying to figure out, well, QSBO seems to be suggesting earlier, the bank's Reserve Bank of New Zealand still saying, August 2025, pretty big gap coming through here. What's your read of pricing?
Yeah, I mean, I'm reluctant to move our sort of pick for when the first rate cut comes through, because it has been a little bit all over the place the last few months, because the Reserve Bank has sort of jumped from one to the other. And one moment they're not worried about price pressures, and the next minute they're still talking about the stickiness, particularly of that non-tradable or domestic inflation. Again, if we look at the pricing measures right across the board, whether it was costs or prices over the last 3 months or the next 3 months, all of them are coming down. They're all still a little bit above their sort of historic norms from the last 30 years, but not by much anymore. They have come down by sort of considerable amounts over the last 3 or 4 quarters. And indeed, if you look at sort of pricing over the last 3 months, again, that one maps quite nicely with headline inflation. That's suggesting that inflation in 3 to 6 months' time will be back under 3%. That lines up with our forecasts. And yes, okay, it doesn't quite tell us about some of those non-tradable pressures, particularly the correlation there isn't necessarily quite as good. And so at the moment, just sort of waiting to see how over the next couple of weeks, firstly, the Reserve Bank with their upcoming monetary policy review, how they react to the QSBO, whether they sort of take a bit more of a sanguine view. Even then, I'll be a little hesitant to move too much, given that, as I said, they are all over the place sometimes in terms of their thinking. The other indicator, of course, the key one is what does inflation actually look like in the June quarter? That's due out in a couple of weeks' time. And all the indications are that those figures do look like they'll be weaker than we were thinking 3 to 6 months ago, and probably weaker than the Reserve Bank's forecasts as well. So there does seem to be good news coming through in that inflation front. But the Reserve Bank has sort of put themselves or painted a picture of themselves so much they're like, we want to see inflation back at 2%. We want to be sure it's back there. That, look, even if it gets under that 3%, I don't think that's necessarily a guarantee of a rate cut. I think the clear narrative has to be their August story, August 2025. That's way too late for when rate cuts need to start. But at this stage, is it November? Is it February? Going to stick with our February pick, noting that, if things go well over the next few months, maybe it could come earlier, but there's not enough evidence at this stage.
Totally, and I think that comes back to that point, right, that, the QSBO is a survey, and it's a very good survey, it's a very long-running survey, but the Reserve Bank, in our minds, given how strong they've talked in recent times, will also be wanting to see a little bit of that actual, real, hard, fast, actual evidence that inflation is coming down, rather than just being told by businesses that it's coming down, and then, actually the number's a bit too high that comes out the other side. And, of course, the confusing thing going forward, like you've highlighted, will be what happens if you have non-tradables that are high, headline inflation is coming down, the QSBO that sort of shows those pricing pressures are dissipating. How does the Reserve Bank weigh that all up? And probably most importantly, what do they communicate out to us? I mean, we've moved our pick already this year 3 times. We started the year and thinking it was an August 24 cut. Then we moved it out to November. Now we've moved it out to February. And I think we're still sort of going, look, we would, if we were in the decision makers chair, probably go for November, but the bank seems to be a bit more wary and having to push it out. The question is how much this twists around. We'll assess how all of that goes, how inflation and reality trends, and how the Reserve Bank reacts to all of these various data streams on one of our future editions of Econ Talks.